Good morning, everybody. Today, I want to make sure we discuss how to pay yourself as an LLC in 2026. I like creating videos of the most common or misconstrued concepts that clients ask me in our tax strategy practice. And how to pay yourself as an LLC is a huge topic where business owners and individuals do get confused, and there's a lot of layers to unpack. And I'd like to equip you with the tools that you need to be able to make the right decisions. Because, from my perspective, when you understand the numbers don't lie. And you're then more equipped to make better business decisions, have more cash flow, and pay less taxes, keep more money in your pocket, and you then become in charge and you become the steward of your finances and your business. So that is the goal. All right, so going back to how to pay yourself as an LLC. When one starts a business, they typically start with an LLC. And LLCs are very popular actually because they're governed more by each state. So you would register the LLC with whatever state you're in. However, there's a massive misconception about how to pay yourself as an LLC because LLCs aren't all the same. When you're in an LLC, and you get registered with the state and you get an EIN number from the IRS, you have many options of how you want to be taxed. And this is not a common conversation that I'm hearing people talk about. So I want to make sure you're equipped with the right tools here. An LLC, if you have a single member LLC, the default rules are that you are a disregarded entity, that you're a sole proprietor. And that means you don't file a separate business tax return for that LLC. You actually file on your personal taxes. And if you have a multi-member LLC, your default rule is being a 1065, which is a partnership for tax purposes. So those are the two major differences right there. And if you don't like one of the default rules, if you don't like being a sole proprietor, and if you don't like being a partnership, you have the ability, whether you're a single member or a multi-member, to be able to elect into a different tax structure. You can be an LLC sole prop, you can be an LLC S corporation, you can be an LLC partnership, or you can be an LLC C corp. And that, my friends, is the delineation with how you need to pay yourself. Each of these entity types have different requirements on how to take money out of the business and compensate yourself. And I'm being careful with the words I choose here because I don't want to confuse you with the incorrect terminology. So, as a sole proprietorships, you have the ability to have the easiest pay structure. But when you do, you don't necessarily have the biggest tax advantages for your business. So, for example, if you're a sole proprietorship, you are not required to take a payroll, meaning you're not required to have W-2 wages in your business. All your profits in your business, meaning your revenue minus expenses equals your profits, all your profits are taxed. And that taxation is on your marginal tax rate and self-employment tax rate. So you're having an additional 15.7%, and I'm rounding up for a reason. You're having an additional 15.7% taxed on your business profits as a sole proprietorship. And this isn't good or bad. It just means that you need to be aware so that you are making the right tax planning and business planning decisions to get you in a better position. And so you understand what cash flow you're going to need at the end of the year. Okay. Then when you decide or if you decide or if you get advised to be an S corporation functions differently. When you're an S corporation, you must take a payroll. And I'm going to go through some do's and don'ts here as well. When you're an S corporation, you must have W-2 wages when you are the shareholder, okay? When you're a more than 2% shareholder. And what that means is the following, and I'm going to unravel this. Number one, in an S corporation, actually in any business format, your profits are revenues minus expenses equal your profits, or losses if you had more expenses than income. In a sole prop, which we just discussed, those profits are taxed at two rates, marginal tax rate and your self-employment tax rate. In an S corporation, your profits are just taxed at your marginal tax rate. Okay, so what does that mean? People assume automatically that the S corp is better. It may be better for you, but maybe it's not, just depending on what your business goals are, depending on what type of industry you're in. It depends how many employees you have. It depends what you are looking to do and accomplish, right? Because the more tax planning you have, the more it costs you either financially to upkeep the plan or time-wise because you have to substantiate it more. So that's another video that I have, and I welcome you to look at that as well. So in an S corporation, you are required by the IRS to take a payroll, W-2 wages. And it's not any W-2 wages. It's not whatever amount you think you should take. It's not the quote unquote old school theory of, oh, I'll just take 50% of my profits as payroll and 50% of my profits as distributions. We can't approach this willy-nilly. We have to approach this in a way that makes sense, is audit proof, is tangible, makes sense for your business, and is reasonable. So the IRS requires reasonable compensation. And what does that mean? Is there a formula? How do I figure out my reasonable compensation? The answer to all of that is yes. So when we look at your business and how you're taking money out of your business, how you're paying yourself, we will go through a reasonable compensation audit analysis to figure out what your best salary is. That's reasonable. And there's a lot of factors that go into determining what reasonable is, what this salary should be. It depends what industry you're in. It depends what state you live in. It depends what region within your state, locality. It depends what role you have in your business. And many times as business owners, we wear multiple hats. So those roles are identified through this reasonable compensation analysis. That reasonable compensation analysis will take and pool payroll data, real live payroll data that will determine what your salary should be. And when we're able to generate this type of report, this type of analysis, this type of reasonable compensation audit is meant to show the IRS that you did your due diligence as an S Corp owner. You did your due diligence in figuring out what your reasonable compensation is so that you don't overpay yourself and you don't underpay yourself. And everything goes well, meaning if you have the report and it was done honestly and you're operating based on the reasonable compensation, it should withstand an IRS audit. Okay, so I belabored that a little bit, and I hope the point is being driven home here. The benefit of being an S corporation, so remember sole proprietorship, there's a reason why we started there, marginal tax rate and self-employment rate. S corporations are only taxed at your marginal tax rate because you're taking a reasonable compensation. Your W-2 wages are subject to your Social Security and Medicare taxes as an employer and an employee, and your state unemployment or reemployment, whatever your state calls it. That's why I rounded up the rate to 15.7%. Your payroll covers that piece. That's why the IRS wants you to have a reasonable compensation as an S corp, because one of the bad seeds, or there's typically when something occurs that forces other business owners to do something a very certain way, like taking payroll when you're an S corporation, there were bad seeds in the past, and people abused this sole proprietorship to S corporation election, and they just did it so they could circumvent not paying that self-employment tax. And that's a big no-no. You do not want to do that or get caught in that type of business practice. That's a wrong practice. So what the IRS did was, okay, to prevent people, to prevent business owners, to prevent more than 2% shareholders from just avoiding that 15.7% of self-employment tax, which is the employees and the employer's portion of payroll taxes, we're going to require a reasonable compensation for S Corp shareholders to take. Okay, logically, that makes sense. What you don't want to do is over or underpay yourself. We want to get something that's reasonable within your industry and how much time you spend in the business. All right. Then, once you take that, you are then allowed to take a distribution from your business. And a distribution is tax-free money. And I do a whole other video about this because there's also a lot of confusion about what that means, about how much you can distribute, what tax-free money actually is, and can you just take any amount? That's another video that I encourage you to look at because that can get complex and it touches on something called basis, which a lot of CPAs and enrolled agents and tax professionals cringe at, and clients as well, because there's a misconception in how to understand it. And basis actually limits how much you can take in distributions. Another video, I'm going to simplify it here. So, as an S corporation, you pay yourself a W-2 wage, you meet the IRS's minimal requirements for reasonable compensation, and now you can take a reasonable salary. Or excuse me, now you can take a distribution. So with the distribution, you can withdraw money that's tax-free in the business. You can withdraw it tax-free to yourself. Hold on here for a second. You can withdraw it tax-free to yourself as long as there is enough basis. I'm going to make a broad scope assumption here. Basis would be, do you have enough in your retained earnings from prior years, less your distributions, plus your shareholder loans, plus any capital contributions, and net that with your business profits or losses this year. That combination of 5 things tells us your basis. There's a few caveats with basis, which I'm not going to dive into here because it adds a lot more complexity, but that's a reasonable way for you to determine if you can actually take a distribution. And number 2, what's your limit in what you can take? And then reasonably, what do you actually want to take? And the reason I'm phrasing it this way is because we don't want you, and as a business owner, you don't want you to deplete the entire business of cash. Because if you do, then you don't have any reserves. You're going to have potentially struggles in paying your operating expenses, your payroll, your future business expenses, servicing debt, etc., etc., etc. So that formula long ago of what one should pay themselves and what one should take in distributions, other professionals used to say, well, just take a 50-50 split. But that's guessing. That's really guessing. 50-50 split between your W-2 wages and your distributions. We don't operate that way, and we encourage you not to operate that way as well, because you can potentially be leading yourself to some serious trouble with the IRS if you practice it that way. So when you figure out what that distribution is, Okay, I encourage you to speak to your tax professional to figure out what that amount is and make sure you have your reasonable compensation. Those two components allow you to pay yourself out of your S corporation. And that is a solid formula to make sure you're compliant, you're doing it properly, there's proper tracking, cash flow, documentation, and a great paper trail. And you're not over or underpaying your taxes and you're not over or underpaying yourself your wages. Okay? When you're operating as a partnership, meaning not operating as a partnership, let me take that back because that's a misconception there too. If you wanted to have a partnership, you would probably elect and create an entity that is a partnership because there's a lot of different benefits and restrictions for liability, et cetera, for an official partnership. An LLC electing to be taxed as a partnership is different from an LP or an LLP, limited liability partnership or a limited partnership. They're different. So I want to make sure we draw the line there. We're not talking about limited partnerships or limited liability partnerships. We're talking about LLCs electing partnership status. And actually, let me take that back. LLCs that are multi-member LLCs are automatically treated as partnerships for tax purposes by the IRS. Now, you may elect to be treated as a partnership with the IRS as well. And make sure you talk to your tax professional because those elections, unless there's very specific exceptions met, you can't retro these elections. You have to be able to plan so that you can actually elect for the future. There are exceptions to this for new entities, and there are exceptions if you have reasonable cause, but those are few and far between. So I just want to make sure you are aware of this. In LLCs being taxed as partnerships, there is also a payroll requirement, but it's technically not via W-2 wages. It's guaranteed payments. And guaranteed payments have their own separate set of rules. And guaranteed payments to the partners for tax purposes for that LLC being taxed as a partnership, they can be paid via payroll. They can have payroll taxes withheld if you process it through a payroll company, or if not, then those payroll taxes will be passed through to the owner as self-employment tax. I want you to think about for a moment going back to the sole proprietorship. Sole proprietorship, right? You get taxed on your profits and you get taxed at your self-employment rate for all your profits as well. Two types of taxation. S Corp, we talked about. You have your W-2 wages that are taxed at self-employment, although it's not self-employment, but they're taxed as with payroll taxes, and the profits are taxed at your marginal tax rate. So those are the differences there. And as a partnership goes, LLCs being taxed as partnerships, those guaranteed payments are allocated payments where once again, we still have to do a reasonable compensation. We still have to do a reasonable compensation report for LLCs being taxed as partnerships, but it's handled a little bit differently. There's some people that still take their wages via W-2 wages, although technically that's not correct. You should be taking guaranteed payment because what that does is unlike the S corporation where you have your reasonable compensation and it runs through W-2, you would still have your reasonable compensation and an LLC electing to be taxed as a partnership. And when it's paid out as a guaranteed payment, you're actually saying, okay, Mr. IRS man, I'm taking this wage, my salary, my reasonable salary, and I'm allocating that salary requirement, and I'm allocating it to myself, and I'm going to pay self-employment taxes on my personal tax return because it's a flow through. So a little different rules. And also, LLCs, election to be partnerships can also take distributions as well. They're called partner distributions instead of shareholder distributions. So there's semantics here. But remember, I'm not going to belabor everything we discussed with the S Corp. There's the rules are similar to how you take distributions out and how much you can take and when you should take it. What I'm going to also add in here to both S Corps and partnerships, LLCs elected to be partnerships, the distribution definitions, the distribution requirements are different. So this is very interesting. In S corporations, if you have more than one shareholder, your distributions have to be equal to everyone's percent ownership. In an LLC electing to be a partnership, your distributions can be any amount up to the partner's basis. You don't have to distribute an equal proportion to your percent ownership or percent partnership. So that's a big difference right there. Big, big difference. And I encourage you to talk to your tax professional. If you don't have one, please reach out to us to make sure that you are not only following the rules as you need to, but you're also not raising red flags for the IRS. Now, when you're an LLC electing to be a C Corp, that's also very, very different. And C Corps have completely different rules because they're not flow through entities. I always say that the buck stops at the C Corp. So you're paying 21% corporate taxes on the C Corporation, and whatever state you're filing in, whatever your state filing requirements are, you're also paying that state tax. But the C Corp, the buck stops there. It's not a pass through like the sole proprietorship that gets taxed at your marginal tax rate and your self-employment rate. It's not an S corporation, right? That gets taxed at your marginal tax rate pass through. It's not the partnership where it also gets taxed at your marginal tax rate pass through. So the C corp and these marginal tax rates, let me emphasize this a little bit. Your marginal tax rates could be anywhere between, 0 and 37%. So they can range significantly. The C corp, its taxation is at 21%, and that C corp tax is paid by the business, not you individually. The C Corp is the most restrictive in how you can take money out and pay yourself. Reasonable compensation still required, okay? You can pay yourself in dividends. You can pay yourself back loans that you made to the business, okay? You can pay yourself a board stipend via 1099 format, and there's other nuances there as well, but you can't do a shareholder distribution in the C Corp. Can't do it because essentially you're paying a dividend to the stock holders. Okay. So I really, really hope this helped. I hope this helped. I believe you have more questions now. So I am creating a few more videos to get into the nuances of a few items that we just discussed here. But I really, really hope that this helped you plan and equip you with the right questions so you can speak to your tax professional so that you are set for the 2026 tax year and beyond. I hope you're living life wealthier, and please like, subscribe to our channel, and leave comments below so that you can share with me what you would like for me to talk about next. Take care. Bye.